This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Here are your TF Metals Report podcast highlights for the week of March 22nd, 2021. We began the week under considerable pressure in COMEX silver, pressure that would remain all week long. It began Sunday night at the Globex Open, though. Right from the opening bell, silver had gapped lower and was pressured more than 60 cents lower in just the first hour of trading before anyone was paying attention, anyone was awake in Asia or awake in Europe for that matter. Very frustrating start to the week and unfortunately a precursor of what was to come. At the end of the day, though, you can see it on the daily chart. We've now spent the better part of at least the last 2 weeks pinned below that 50-day moving average. Well, hell, I just showed that to you in the other chart. But really in a range between 27 and 25. As long as 25 holds the support, especially closing support, then we're okay. And really the downside from there is we're only really to 24. But we got to get up and moving. Again, check out the trend line from the February 1st silver squeeze high to the bounce back in late February. Notice how that was enforced today too. So again, in my humble opinion, and I've only been doing this for 11 years. And again, what I do here is manipulation analysis, trying to tell you what the banks are going to do to paint the charts against you and the rest of the other specs. If you look at it through manipulation analysis, then today's smash, where the human beings took over, well, the monkeys took over, I should say, took it away from algos, which would have driven prices higher and instead drove prices lower. Because of the impending breakouts, whether it's the trend lines, whether it's the trend line on the silver daily chart, whether it's the red arrow on the gold chart, they're doing everything they can to keep it going lower. Sometimes events conspire against them to prohibit them being successful, and that's what we're going to have to hope for as we go through the week. On Tuesday, March 23rd, our focus turned to gold, which had tried to break out last week. Unfortunately, was unable to do it. It was held below 1750 and now is being pressed lower by the same trend lines that have been in place since August. This was a big topic of discussion on Tuesday. So what will we watch? I think this chart is pretty clear. Again, this is that 2-hour candlestick chart coming down from the 1st of February. Now notice, we make a low on about the 4th or 5th of February in that 1780, 1790 range, and then you bounce. Comes down, tries to hold that low 2 weeks later, and as soon as that low is broken, you move to a new lower low, this time around 1760. Tries to rally. Comes down about a week and a half later, tries to hold that level, and then as soon as that fails, bang, we go all the way down to 1680. And make another lower low. So we're not yet at a spot where you're like, oh my God, here comes another lower low. But getting back failing to get above 1750, and what they've done to us since last week is kind of disappointing. So we'll watch now. As we said yesterday, 1720 is important. All these numbers with a 10, 1710, and then 1700. Man, if we break below 1700, then all we can really hope for is a double bottom at 1680. But you can see how this goes. We're making a series of lower lows. What we need to do is make a higher high or a higher low. And I just haven't done that yet. Wednesday's podcast was a wide-ranging discussion, not only of the precious metals, but of the macroeconomic conditions and the deficit spending in the U.S. that has gotten out of control. Next week, we'll bring an announcement from President Biden of what could be a $3 trillion infrastructure program financed by more deficit spending. Eventually, this will lead to a policy of yield curve control by the Federal Reserve, and when that comes, the precious metals will soar. Now, how many times have you heard me talk about the Fed's history of yield curve control? How they've done it before, and if you've done something once, chances are almost infinitely greater that you're going to do it again, rather than having never done it before. Well, the Fed instituted yield curve control in the years around World War II and after, as the debt to GDP soared above 100%. They've done this before. That's the way they inflated away the debt. They let inflation run above long-term interest rates. Negative real rates inflating away the debt. That's when they used yield curve control before. You've heard me talk about it. But here is Steve Goldstein, whoever that is. Who is Steve Goldstein? I bet it says down here at the bottom. Anyway, Steve Goldstein writing for MarketWatch.com. Headline, Powell and Yellen's game plan is evocative of the World War II playbook. Here's what happened then. And as you read, to mobilize against World War II, federal debt tripled, balance sheet swelled tenfold, and the Fed capped both long and short-term interest rates below the rate of inflation. So there's one mainstream mention today of yield curve control pending. Then there's this little tweet that I saw earlier today. And the image you see on this page is yours truly saying yield curve control. There's a novel idea. Here's Charlie Gasparino. Remember him? He used to work for CNBC, and now he works for Fox Business News. As Biden White House leaks details of its next spending blowout. Remember this idea of $3 trillion? Oh, no, it won't be $3 trillion. Then if it's only $2 trillion, people will think he's being modest. The growing number of big investors believe that the Fed will soon launch yield curve control. You sensing a message here? More and more mainstream people are figuring this out? Yeah, not just yours truly. For this week's Thursday conversation, we introduced a new guest to TF Metals Report. His name is John Adams, and he's an economist from Australia. Living in Australia, he knows all about the Perth Mint and some of the other unallocated bullion programs that are run in Australia and actually around the world. And he is witness to some of the stress those programs are experiencing. Please stop by the homepage of TF Metals Report and listen to this entire free conversation when you can. For now, here's just a small sample of what John had to say.
Before I give you a couple of specific examples, Craig, I will say that having spoken to now the official line from the Perth Mint is there is an issue around manufacturing small products, but they have 60 tons available for sale. That's a direct quote of 1,000-ounce bars. I have a wholesaler on the East Coast who attempted to buy 1 ton of silver from the Perth Mint in 1,000-ounce bar form, and the intention was to ship it across to a refiner in Victoria on the East Coast and melt it down into small retail products and to resell it to the public. The Perth Mint was refused to take that order. Now, when it comes to customers, in that situation, I should say, obviously the Perth Mint's under no legal obligation to sell a ton of silver to a prospective customer. But when it comes to holders of unallocated or pool allocated products, the Perth Mint website is categorical in that if you have an allocated position, delivery in 2 days, 48 hours. If it's in the vault, you get it in 2 days. If it's unallocated or pool allocated, it says it's 10 days. Now, in this interview with the Australian Broadcasting Corporation, Richard Hayes basically tried to change the definition of his own terms and conditions. It says, well, 10 days doesn't actually mean you get silver. 10 days is that we are going to arrange quotation arrangement for freight costs. Now, that's a complete outrage because anyone in this industry knows that even for the most complex transaction, to arrange a quote and to arrange for freight, it's 2 days max. You probably do it within a few hours, but if there's a bit of back and forth, maximum 2 days. You don't need 10 days to arrange a quotation. So obviously the website says 10 days, and people have been calling up.
And on Friday, March the 26th, we end the week much the same way as we began it. The bond market selling off, meaning interest rates are rising, and the dollar up as well. That's always a toxic stew for the precious metals. And on the week, COMEX Gold is going to finish about $10 lower, with silver down more than $1. No fun at all. Now, we turn to next week. Things will begin to get interesting again. First, President Biden in the U.S. is going to announce his massive infrastructure plan, maybe as much as another $3 trillion in deficit spending. After that, we get the end of the quarter. That's always interesting, with the pricing of the options for the LBMA and, of course, quarter-end shuffling of the deck chairs worldwide. And then the week will come to an end next Friday with the latest employment numbers in the U.S. But on Friday, March the 26th, it was just another ho-hum day for gold, with price pressed lower below the trend line that we've been monitoring since August of last year. That same line providing stiff resistance all week this week. Thanks again for listening to the TF Metals Report weekly podcast highlights. If you enjoy this service, please subscribe or like to the channel that you listen to. And then also please stop by tfmetalsreport.com and check out all your subscription options. It's only $15 a month or 50 cents a day. We hope to see you there at tfmetalsreport.com.